Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I am glad to have you here with me today. Thanks for being here, whether you're here in the live version or in the recorded session. We're glad to have you here. Be a part of that conversation. Chat in your comments and questions. If you're in the recorded session, leave us a comment in that comment section. We'll get back to you as quickly as we can. I believe I've got Cameron May in the chat here this morning, 20-plus year veteran of the financial markets and a great educator in his own right. And thanks to all of you. Hey, we've got a few things to talk about today as the market seems to be moving back up again today following some revisions to jobs numbers and a few other things that have been going on. Market moving a little bit higher. Now that may stay that way, it may not stay that way. And we've got a lot of volatility perhaps bleeding back in going into next week's Federal Reserve meeting. We'll talk a little bit about that as part of this conversation as well. And in anticipation of that, maybe the idea of a buy the rumor, sell the news perspective, we're going to take a look at a couple of hedging positions as a possibility as well for our portfolio as a whole. So let's jump into that really quickly. And as we do that, a couple of quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes only. We are not making any kind of a recommendation or any kind of an endorsement about any particular security or strategy. Remember that investing involves risk, including the loss of principal. Past performance not a guarantee of future results. Also, remember that equity and index options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Also, remember that multiple leg option strategies are going to entail multiple transaction costs, that spread trading in most cases needs to be done in a margin account. Now, we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of that platform. Now, one thing to keep in mind is that the paper money platform, while a great learning environment, never a guarantee of future success, though, doesn't do certain things that a live trading account would do. A couple of those are, it doesn't allow for studies in scans, but probably the biggest one, and we'll talk about it specifically in reference to what we're talking about today, and this particular webcast, is that the paper money account does not facilitate the early assignment of short options. Now, since we're talking about index options, we're focusing on European style index options that do not allow for early assignment. They don't allow exercise of those options prior to expiration. So you don't have that early assignment risk. But just be aware, if you're trading both equity options and index options, your American style short options can be assigned at any time up till expiration. European style cannot. So we take that out of there. But in paper money, that's not going to happen. Live trading, it will happen. So probability analysis, technical analysis, fundamental analysis, all of those are theoretical in nature. None of those are guarantees. Schwab doesn't recommend the use of technical analysis, the only means of investment research. And when we talk about stops, which we'll talk about as we get into this discussion, remember that stops aren't a guarantee of where that price or where that order is going to get filled. It simply allows us to designate a price at which that trade would activate. So let's jump into this discussion this morning and take a look at what's going on in this index movement. Now, I want to answer one particular question that's come up in the chat, and that chat question is simply this: because we teach over 30 hours of live webcasts every single week. We record all but 2 of those webcasts, including this one. We record this one. But we do not record the 2 webcasts that focus on ETFs, exchange traded funds. That is for regulatory reasons that we cannot record those ETF content specific webcasts. That is the reason why. So that's just the reality of the regulatory environment in which we live and operate. So let's talk a little bit about this idea in terms of what's going on with the indexes this morning as we cast our eyes around the market, taking a look at the SPX. Remember, I said that the market may be moving a little bit higher here, which is interesting because if we take a look at the SPX, we see that move to that new all-time high, but it's a little bit of a gap up sell-off today in response perhaps to those jobs numbers, but also some PPI numbers that were a little bit lower, suggesting a little bit stronger movement. Here's the conundrum that we're in as far as the market is concerned between now and the Federal Reserve meeting. Is we've got kind of this perspective of, is good news, or is good news bad news, or is bad news, or is bad news good news? Does the fact that jobs have been tanking, those jobs numbers revised down, suggest that there is more weakness in this economy and therefore justifying to a greater degree the idea of a rate cut? If there's weakness in the market, however, does that suggest that the economy is so weak that it's not going to support the valuations that are currently existent in an index like the S&P 500, which is a broad market index? It doesn't cover the entire market, but it is the majority of, or a fair majority of, kind of a cross section of the market. So that's the conundrum under which number one, the Fed works, and number two, under which we work as investors in the market. Is good news, or is good news bad news? So, or is bad news good news? And I think at this particular point, the idea is that as bad news comes in, kind of that job revision, we're still seeing some upward lift in the index. We're still seeing some upward move here in the SPX, pushing this index price higher, but coming to the realization that maybe that is not such a great thing either. And here's where I get into this idea of kind of the buy the rumor, sell the news. So the market moving higher, now ahead of the FOMC meeting, we see this moving to the upside here. And we see that kind of across the board. NASDAQ up a little bit, right up against, almost up against those all-time highs. Very, very close to. And the Russell 2000 kind of backing off a little bit. This is kind of the conundrum, again, that interests me, because we have the two broader market indexes, are arguably kind of a larger cross-section. SPX for sure, NASDAQ more tech-heavy, but also including some other things as well. And then the small caps, which should be more reactive positively to an interest rate cut. The small caps backing off a little bit here. And that may be where that bad news becoming bad news, the jobs revisions downward coming home to roost, because that's largely impacting these small caps. So I think, we're seeing certainly weakness here in the Russell 2000, not terribly weak, terrible weakness. I think we're seeing perhaps a little bit of what Pat Mullally and I used to call a cobra pattern, where we get this little kind of squeeze at the top of this run, and momentum kind of squeezing as well. That RSI is a sentiment / momentum indicator, kind of squeezing up into that range. So that's the backdrop that I wanted to look at here. So we've got a Russell 2000 that's moving down a little bit. We've got a gap up sell-off on the SPX. We've got a gap up and a little bit of a sell-off, tiny sell-off in the NDX. But that's ahead of the actual rate cut. So once that rate cut comes out, if that is the ultimate result, and if you were with me in our futures webcast, trading futures webcast yesterday, we talked about how you can calculate the likelihood and the expectation of the market for a rate cut, even if you didn't have access to external tools like the CME FedWatch tool, which we didn't yesterday. So we calculated it using the futures contracts. But once that rate cut happens, if it happens, I just have to put that caveat in there, that could then lead to the market selling off, perhaps, because what was expected has now happened, and now the market has already priced that in, and they move on. So they digest the reality of the market being a little bit, or the economy being a little bit weaker. So from that perspective, there is some idea perhaps of hedging a portfolio against that adverse movement. So we're going to talk about hedging. The other thing I wanted to look at here really quickly is the VIX. And I just wanted to spend just a moment talking about the VIX, the volatility index, because despite the fact that we have a gap up and a little bit of a sell-off, we still have the VIX down a little bit. Normally when we see downward movement in this particular case, we see the VIX popping up a little bit, and it is not in this reality. So as we start to see the VIX kind of still settling into the high 14 handle, just not seeing a lot of elevation. That does not mean that it can't. And that does not mean that it won't. If we were to see the market moving lower, if we were to see, a bigger sell-off like we saw a few days ago, we could see the VIX make a little bit of a spike, but not, you look at where these spikes have been recently, and they've been tempered. Now, this does not take into account news, because news can happen at any time, and news can come out of nowhere, and news can change this perspective. So again, one of the things to be cautious about is getting lulled into this lower grind in the VIX. And we asked this question last week: is the VIX continuing grind, or is it end of summer and we're starting to see some additional volatility? And I would argue that those that said that we're just seeing more of the grind are probably, at least at this point, right. At least until the FOMC meeting, and we'll see what that plays itself out to be. But what that also means is that with the VIX low, because remember, this is a reflection of option premium in the SPX, that would tend to indicate that our premiums are going to be fairly low. So let's pop over here to the monitor tab really quickly, and let's take a look at our our SPX weekly group, which is where we talk about our 14-day, 7-day SPX short vertical strategy. So I know that there are a number of you that are here that are brand new. So we're going to take just a moment to talk through this, but then we're going to manage this particular strategy. The strategy idea is simply this: we sell at 14 days to go until expiration a 1 standard deviation short vertical spread, either above the market or below the market, depending on which direction the market is moving. Right now, the market is still moving higher, so we are selling a short put vertical spread below where the market is. And the expectation is then in this strategy, we buy that vertical spread back at 7 days to go until expiration the next week, come what may. And the intent is to capture rapid time decay at the front end of that time frame, and 2, capture that directional movement, although biased primarily to time decay because of the way that trade is structured from the option Greeks. So here's the trade that we put on last week. We sold the 62.40 put. We bought the 62.20, $20 wide short vertical spread. We sold that vertical spread for $2.10. We can now buy that spread back for for 25 cents. So we're capturing the majority of the gain in this particular trade. Now, I'm going to just be cautious about this and say this again. This is a strategy that works until it doesn't, as any strategy is, but until the direction of the index changes, that's where we start to run into some challenges in this particular strategy, when there's some variability in direction, because directionally, delta can overcome that theta component pretty quickly. So this is a relatively neutral directional strategy, except that we still want upward movement, but it is a pretty biased time decay or theta strategy. So we're going to do this first. We're going to right-click, and we're going to create a closing order. We're going to buy this back. Now, some traders are going to say, well, wait a second, it's only 25 cents. Let's just leave it, right? Let's just leave this vertical spread in place and let it expire worthless. We could do that, but we've talked about the fact that news can happen at any time, and the risk existent in this trade, $20 wide vertical spread, we brought in $2.10, which means that we have about $18 of risk theoretically, right? To get to that maximum theoretical risk in the trade, we have about $18 of risk. So carrying $18 of risk for another week for the sake of 25 cents doesn't make a lot of sense. closing the trade down positively prior to expiration when it's done the majority of the work. That makes more sense in this context because we avoid that risk. And again, there's the answer, Michael, to that question. Why 7 days versus 0 DTE? Because, again, bunch of risk over 7 days, but we've already captured the majority of the gain, right? Same amount of risk. I mean that same amount of risk exists in this last 7 days, but we're taking on that risk, or we would be willing, if we were to hold this till expiration, we'd be willing to take on that additional or that same $18 of risk for the sake of gaining another 25 cents. Why not close this down prior to expiration, sacrifice the 25 cents, and move on and do it again, as opposed to running the risk of taking an $18 maximum theoretical loss for the sake of picking up 25 cents. It's nickels on the railroad track in front of a freight train is kind of the algorithm, the analogy here, right? So I'm going to go ahead. We're going to buy this one back. In order to buy this back, I'm going to give it a little bit, and we'll give it actually 30 cents limit. We'll click on confirm and send. We'll close this down. We'll read through this order, make sure that we're aware of what we're doing, and make sure that it says to close. We'll go ahead and click on send, and we'll fire that order off. And we bought it back for 25 cents, which meant that we got the majority of that $2.10 that we sold it for to begin with. We got all but 25 cents of that $2.10 in terms of that maximum theoretical gain in the trade, right? So exactly, Jack. But Jack brings up a good point. Jack says, "Well, wait a second. What's the risk on a $20 spread? $18 of risk versus $2 of gain." Yeah, that is again not a great positively skewed risk to reward. But how do we do this? It's a highly probable trade. That's the way we set this up, is that it is a highly probable trade. So let's talk through this next portion of this trade. Let's go to the graph let's put our index grid on here. And here's the index options grid. This is the SPX. So the trigger directionally for selling a put spread versus selling a call spread is this right here, the 100 period moving average. So or actually 200 period, I think we've got 200 period. Yes, 200 period moving average. So if the SPX is above that moving average, then so if this is up here, we're selling a short put vertical. If it were the other way, so like when it was down here, when the SPX was down here, we were selling short call vertical spreads. That's the kind of directional relationship here in organization. So we're above the moving average, we're selling short put vertical spreads. And now on this right-hand side, this chart is plotting that probability of expiring cone. The probability of expiring cone, simply a study that we've put on here. You type in the words prob, and you get probability of expiring cone. That probability of expiring cone puts that range, that curve, if you will, that parabolic curve, centered on the current trading price at 1 standard deviation. How do I know it's 1 standard deviation? I can see that probability is at 68%. That's 1 standard deviation. That's 68%. That's 1 standard deviation above, 1 standard deviation below. And then we put a timeline, a time hack at that 14 days to go until expiration interval. So I'm going to remove that one. We're going to go to our trade tab. We're going to look at the SPX and we're going to say, where is 14 days to go until expiration? 14 days to go until expiration is the 24th of September. This 24th of September is going to be beyond the FOMC interest rate meeting, right? Where there's the potential for a rate cut. So this one is fraught with a little bit of potential for some movement here. Now, 14 days to go, and I want to do this really quickly, but I know that several of you have requested this. So here's the graph that I've drawn every time we've talked about this. That's expiration. This is option price, and this is time. Okay, that's the graph. Normally, the at-the-money strike, an at-the-money option, ATM, time decay curve looks like this. It gets faster as it gets closer to expiration. And we would normally look at selling in this time frame to capture the balance between enough premium and the rapid rate of time decay. That's the at-the-money strike. But we are selling in this strategy let's grab my magic marker here one more time. We are selling the out-of-the-money strike, OTM, one standard deviation out of the money, which oftentimes puts us around the 15 to 17 cent delta is about where this falls. The time decay curve, same expiration out here, same place where that expiration is, same axes, but the time decay curve for an out-of-the-money option tends mathematically to look like this. It slows down as it gets to expiration. So the rate of time decay here in this range, so let's call that 7 days to go until expiration. And if this is, we'll call that 7 days to go right there till expiration. We'll call this 14 days to go until expiration. The reason we are selling 14 and buying back at 7 is we want to capture this area of rapid time decay. That's the time at that point at which our rate of time decay is the greatest on the out of the money option. Now, it wouldn't matter, and I'm just going to tell you this. It's not going to matter if you're selling 30 and buying back at 10, or selling 45 and buying back at 20. You're going to get that same kind of relationship. This is fractal. But we're doing this so that we can do this on a repeatable basis week after week after week within the context of this particular class. So this is a lot for educational purposes, but it's a good demonstration of the fractal nature of the option Greeks and that time decay curve and the mathematics of this. So that's the context. So Michael and I think a couple of others had asked for that. And so that's why I wanted to make sure that we showed that relationship here. So we know that we're going to sell at 14 days to go until expiration. That is the 24th of September. So what we're going to do now is we're going to go out to the chart once again. We'll do this quickly. We're going to go out to the 24th of September. That's right here. And we're going to put a time hack. So the time hack is just this time level tool in the drawing tool. So we're going to go out to the 24th of September. And I'm just going to put that right there. So you can see where our one standard deviation area is. You can see that plotted by the purple probability of expiring cone. That's going to put my one standard deviation cross over that line right at 63.50. So that's going to be right about there, 63.50. That's the level at which we're going to look at selling in this particular case. That's the strike that we're going to look to sell in this next iteration of this trade. So now we're going to go, notice where implied volatility is. Still a little bit elevated, not nearly as high as it was. And we look at where we sold last week, and implied volatility was a little bit higher when we were here last week. And that gave us a little bit of additional oomph. And we ended up selling because here's where we sold out here a little bit further out distance-wise from where the price of the index was. So now we're going to go back to the trade tab. Implied volatility has come back in a little bit from last week. We're going to open up the 24th September expiration. And I've got to add a number of strikes here. In fact, we've got to add we've got to put on about 100 strikes. Because remember, we're going to sell at the one standard deviation level, which we said was at the 63.50. So we're going to go to the 63.50 strike. There's the 63.50. And if we were to change this, and you can see it's got some open interest. We're not the if we're selling one contract, we're just one contract in a 66 contract pond. We're not a big fish in that pond. But I'm going to change this layout to delta, theta, and vega. So it's about the 15-cent delta. And what we're going to do is we're going to sell that 63.50, and we're going to buy the 63.30. Buy the 63.30, $20 wide. Okay. And we're bringing in $1.60, which is the lowest we brought in the last few weeks, simply because implied volatility, again, grinding lower. It's the end of summer. We're seeing that VIX low. So we're not bringing in a lot here. Now, could we adjust that amount of credit? Yes. Going wider out, increasing the width of our strikes and making it a 50-point wide or a 60-point wide vertical spread is going to increase our credit, because the call side, or the side that we're buying to provide the definition to the risk in this particular case, is going to cost less, but our risk increases. Because right now, as we look at this, we go to confirm and send, $1.60 maximum theoretical gain, $18.40 max theoretical risk, but highly probable. Remember that if we look at this, what's that telling us? What's that, that 15-cent delta telling us? That this has about a 15% probability that 63.50 is in the money at expiration, which means that it's got about an 85% probability of being out of the money at expiration. Highly probable trade. Not a guarantee, but highly probable. So let's take a look at this. Now, 160, we're going to go ahead and we're going to click on confirm and send. And we're going to put this in our index options weekly group. And we're going to look to take this trade off again next Wednesday. So we're going to read through this order, make sure this is in order to open, make sure that this is what we want to do, make sure that we understand all of the alerts that pop up, and we're going to go ahead and click on send, and we're going to fire that order off. And we got it for $1.60. We brought in $1.60, and we're going to look at taking this trade off next week. So continuing to bring in a little bit each time. Now, the risk is still there. The index could move, but time's always going to continue to pass, right? So because this is a time-dependent trade, that time decay becomes almost the inevitable, and that's going to work in our favor. And theoretically, that's going to work faster in this case than the movement of the underlying index is going to cause the price of that trade to work. So we go back to our monitor tab, and we can see that there it is right there. We sold the 63.50, bought the 63.30. There's our short vertical spread. Okay. Now, high speed, low drag says, when would you consider doing an iron condor? In this particular strategy, you could do an iron condor from that standpoint and increase that premium, and then just manage either side as that happens. And that's fine. There's nothing wrong with that. But when the index is moving in a directional fashion, that may be a situation where, if we go back to that chart, a trader might say, look, I might be willing to sell this vertical spread down here, but maybe sell one up here, or maybe even sell a little bit further out in the event that that index continues to move in that directional fashion, right? Because you're selling counter to the trend in that particular case by selling a short call vertical up here to turn it into an iron condor. Just something to consider as you put this trade together, or as you extend it into, say, for instance, an iron condor. If you were to start to see this maybe find a level of resistance and pulling back a little bit, that might be an opportunity to create it as an iron condor, because then a trader could manage either side depending on directionally which way the trade went. So that's certainly a variation or a riff on this particular strategy that could be incorporated into the discussion. All right, now let's look at a couple of things as we go back to our monitor tab. And I talked a little bit about this last week, and we put this on fairly quickly, so I wanted to talk through it. And that is this long call that we have on the Russell 2000. That long call that we have on the Russell 2000 has about 20 days to go until expiration. We bought it originally for $82. It's now trading for $109. It's gone deeper in the money. But now we sold last week this 14 days to go until expiration 2385 call against that. We turned it into a diagonal. And so we sold that for $25.50. It's now trading at $28.40. It started to pull back a little bit. But what happened in creating this trade, let's go to the chart for the RUT. This is what we did. So we've got a long call. And that long call is benefiting from this upward movement. What's happening in the last 3 days in the Russell 2000 is that we're seeing that little bit of a pullback, which is slowing down the gain in that long call, but it's also kind of mitigating any upward movement in the short call that we sold. This is like selling a covered call, this particular strategy. This is sometimes what's referred to as a poor man's covered call, using a long call option as the cover for creating a short call. We've also turned this into a diagonal spread. That's what this is. Longer dated, long option, shorter dated, short option, creating that diagonal spread. The expectation is the price continues to move in that directional fashion, but we're able to collect premium as it does so. So the driver of this trade is this long call, not the short one. That's simply bringing us in some premium. So we're at a point right now where this has another week to go until expiration, and it's just kind of sitting here. I'm not really comfortable necessarily just kind of leaving that sitting here at the 2385. Let's see where that is. That 2385 is right about just a little bit above where this index is at the moment. The index is at 2379. So what I think we might do is roll this diagonal spread and book a little bit of that profit that we've made in the long option and roll the short option out a little bit further. So I'm going to do this. Let's go to the trade tab for the Russell 2000. Here's our long option. I want to get a little bit more duration here, and I want to get a little bit more directional efficiency, because now this is at an 81-cent delta. I want to move this maybe back to about a 60 delta and book a little bit of that gain that we've made intrinsically on this option, but also gain a little bit of time, because time decay is starting to accelerate on this in the money option. That's going to start working against us to a greater degree. Remember that time decay curve that we looked at. So now what we're going to do is I'm going to look at selling this one back and buying another one further out, but we're gonna go a little bit further down or up numerically, strike price wise. So what I want to do is I want to look out here and I want to say, all right, here we are at 20 days to go until expiration. I want to maybe back this up to perhaps the 24 October. Give myself a little bit more duration here in this trade. And I'm going to look at what that target might be for targeting maybe right around the 65 delta, the 2335. So actually let's go a little bit tighter. Let's go to the 60 delta, the 2355. So we're going to buy the 2355 out here. So what we can do is we can put this trade together like this. I'm going to use my control key, and I'm going to buy the 2355. I'm going to create an order to buy the 2355 in the 24 October expiration. Then I'm going to come back and I'm going to go to this one, which I know that I've got that long position here. I'm going to open that up, and I know that in order to get rid of this long position, I've got to sell it. So I'm going to click on the bid price here, and now what I've created is a diagonal. And I'm doing this diagonal for a 21 cent credit or $21 credit. So essentially, I'm booking the $21 of intrinsic that I've gained here, buying some duration, pushing this out a little bit more in time, and giving myself a little bit more room directionally for this to continue to move higher. So I'm going to go ahead and I'm going to initiate this trade, because what I'm doing is I'm closing one, the one that I'm long already, and I'm opening a new one, the one that I'm now going to be long in that later target date, the September 30th expiration. So we're going to put this in our index options group. We're going to do this now. So once we accomplish that, and we may have to bump that a little bit just to get that to fill. Sometimes that trade, so what I'm going to do is I'm going to right click, cancel, replace the order, and I'm going to open up the lock there. And I'm going to be willing to accept a little bit less premium, a little bit less credit. I'm going to click on confirm and send, read through that order again, make sure that I'm aware of that, make sure that it's still the same, click on send, fire that order off. We'll just see if we can get that moved. Now, here's the thing. In paper money, typically this is going to fill at or near the midpoint of that trade. But remember, we're dealing with two legs here. So we've got a midpoint of the long leg and a midpoint of the short leg to close. So we've got to deal with that. So we may have to bump that around, and it may take a moment. And again, this is also going to be dependent on liquidity in that target. Rolling trades like this are not guarantees. Number one, they're not magic wands. They depend on the liquidity in the target as well. And they don't eliminate transaction costs. They just facilitate the ease of making this trade work. So I'm going to try to bump that again a little bit. Cancel, replace. We'll put this all the way down here to 19 or so, and we'll see if we can get that to fill for us. We'll click on confirm and send. We'll put it in our index options group and click on send. We'll see if we can bump that enough to get that to fill. We'll watch that and see. Now, in the interest of time, I would normally let that fill first. And the reason that I would let that fill first is because I want to positively have that long leg in place before I do anything with the short leg. Because remember, I'm still short this single 7 days to go until expiration, 23.85. I want to give myself a little bit of duration here, and a little bit of duration and a little bit of distance. So what I'm going to do, in the interest of time, normally I would let that long leg settle out, and so that we have a positively settled long leg. But in the interest of time, because the risk is maybe that order doesn't fill, and then we're left with an inadvertent naked position. Now, not as big a deal in an index option from a risk of assignment, but in terms of the impact to your margin, could be a significant, or your ability to place that trade could be a significant issue. So in the interest of time, we're going to do this, right? And we're going to do this now. Yep, that's what we're doing here in this case. So we're going to create a rolling order here. We're going to roll this out and up. So let's do this. We can do it from right here. We're going to roll this out and up. So I'm going to roll this out. By default, when I create a rolling order, it rolls to the next expiration. But I'm going to roll this to the 24th September. So we've got another week of duration. And I'm going to roll it up a little bit numerically to about the 2400 strike. We'll roll it up to about the 2400 strike. There it goes. There went our long leg. So now we're long that option. So we're going to roll this up. We're still getting a credit. We're rolling it for a credit. We're giving ourselves a little bit more headroom and a little bit more duration in this particular short leg. So I'm going to go ahead and click on confirm and send. Make sure that this is what I want to do. I'm closing one and selling another one. And I'm going to put this in my index options group. And I'm going to go ahead and I'm going to hit send. And we're going to fire that order off. And we'll see if that order fills as well. This is recorded, Frank. Absolutely. This one is recorded for sure. So, Michael, that's a good question in terms of useful indicators. Sentiment indicators like the RSI, momentum indicators like the MACD work well with indexes, moving averages. I don't get overly complex. My particular perspective on technical analysis is a little bit like Jimmy Buffett, not too particular, not too precise. There is not one best technical indicator. I use the ones that give me an idea of what is going on. So we may have to bump that one a little bit to get that one to move. And we'll go to our working orders once again. We'll go ahead and cancel, replace. We'll open up that lock a little bit, and we'll see if we can get it for $2 of credit. Click on confirm and send. We'll move it to our index options. We'll kind of bump that a little bit. If we get more, great. If we don't, great. We're still getting it at a credit. And we're going to sell that one and create that roll, and we'll see if that roll fills. And in this particular case, it has not. So we're going to watch that and see. So here's what we've done so far. And I just want to kind of reiterate this really quickly. We looked at rolling this diagonal spread. So we rolled the long leg from an option that was getting 20 days to go until expiration to one that has 44 days to go until expiration and was a little bit less deep in the money, a little closer to the at the money strike. And we rolled, or we're in the process of rolling, the short leg from 7 days to go until 14 days to go until expiration, and we're doing that for credit. So we booked a little bit of profit on the long leg, and we're looking at bringing in a little bit more premium on the short option by rolling out for a little bit more time. So managing that diagonal spread. And then the other thing that we did is we managed our 14-7 strategy here in terms of this perspective. So as we look at this, you know, boy, there is so much going on in terms of the market that it is almost impossible to get to everything. What I want to do really quickly before we go away is I wanted to show you where to find more information. So if you want to find out more information about rolling, you can come here to the Trader Talks webcast page. And that Trader Talks webcast page is at youtube.com/Trader Talks webcast. While you're here, click on that subscribe button. Give us a follow. That helps us out. It helps you out. But lots of great information about rolling strategies, creating rolling trades like we've done today. Also, if you want to learn a little bit more about technical indicators, type in technical indicators. You're going to see how to read technical indicators, 10 key technical setups. You're going to see technical indicators, the MACD, ATR, and moving averages, momentum, things like that. So lots of great resources there as well. And then hedging. And we'll talk more about hedging next week as well. Hedging with index options. I've got a couple of great webcasts. When can you hedge? How can you hedge? Protective puts to hedge a position, using futures as a hedge, index options to hedge. So lots of great ways to use index options as a hedging tool. So join us here in the Trader Talks webcast page. Click on subscribe. Follow me also on X at Ben Watson CS. My thanks to all of you for being here and for asking questions and being a part of the conversation. My thanks to our great production staff for helping out as well. And we will talk to you guys again next week at the least, if not sooner. Some of you I'm going to see in Washington, D.C. this weekend. So looking forward to see you there. Take care, everybody. Bye-bye.